Good morning and welcome to this Monday, August 9th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, last week we got pretty good jobs numbers, saw the market at least start off pretty strong, a little bit weighted more toward the Dow on Friday than the NASDAQ. NASDAQ actually lost ground, but we've seen a really nice move. I think the NASDAQ set its all-time high on Thursday, so it pulled back a little bit on Friday, but both the Dow and the S&P 500 closed at all-time highs on Friday. So pretty good action overall, I would say, in the market last week. It continues to climb this wall of worry, and you can kind of point to whichever wall you want to. There's a lot of different walls of worry. There are a lot of folks on the inflation side. A lot of folks just think we're way overbought. A lot of folks worried about the debt. A lot of folks worried about the virus and the Delta variant surging. There's plenty of worry out there, but the market continues just to shove it to the side and just keeps going higher. And a lot of folks just sitting back, scratching their head, wondering why. But this is what happens in a secular bull market. The market sometimes doesn't really make sense when you start reading the news and then you look at the market. There's no real correlation there. But I think that's important because the stock market isn't the news. The stock market, to me anyway, is the truth. It's exactly what's going on. People are putting their money to work based on all the known information out there, and what we see is what we get. Anyway, we're going to get into all of that stuff here in just a couple of minutes. First, let me go ahead and take you over to Earnings Beats. We do have a new look on our website. Definitely want to point that out. This is a work in progress, so I'm sure we'll be making a few changes, a few tweaks along the way. But I think it's a much better look to what we do. I think it helps to explain a little bit more for someone who's coming into our website, some of the things that we do for our members and for our community. Do want to still point out, if you scroll down, and I welcome you to take a look at our website. We'd love to get your feedback. You can send us anything at support@earningsbeats.com. We'd love to hear from you. But you can still scroll down. You'll find the Earnings Beats Digest newsletter subscription down here. Just simply type in your name, email address, hit that subscribe button. This is an email that goes out, or an article that I send out 3 times a week, Mondays, Wednesdays, and Fridays. There's absolutely no commitment. You don't have to provide a credit card. You can unsubscribe at any time. It's really just something that we do to give back to our community. But we'd love to have you join there. You can check out some of the work that we've done in terms of our portfolios. We've got some information down there for that. If you just want to give us a try over the next 30 days, there's absolutely no cost. You will need a credit card to try for our paid service, but there's no cost. You can unsubscribe anytime within the first 30 days and you won't be charged, but you can get that started right there at the top of the home page. All right, let's move on and talk a little bit about what happened on Friday. So you can see the Dow Jones Industrial Average closed at a new high. After getting up above 35,000, we pulled back, essentially tested that 20-day moving average, and then right back up we go. Nice breakout on Friday. Really like that move. Financials were leading it. We're going to talk a little bit more about that. The S&P 500 up 7 points, closing at a new all-time high at 44.36. So on a percentage basis, not gaining what we saw on the Dow, but that's just typical. I mean, we see this rotation back and forth. One thing I will say is the Dow is trending higher. The S&P is trending higher. The NASDAQ's trending higher. Now, the NASDAQ on Friday did finish down 59 points, or about 0.4%. So not great action there. But we did manage to break out on Thursday, just had a little bit of a pullback, but the overall trend remains higher here on the NASDAQ. Mid caps and small caps don't quite have that same flavor of an uptrend if you look over the last 3 to 6 months, but longer term, there's definitely an uptrend in play. And I think we're just going through a period of consolidation. I expect mid caps and small caps to begin to step back up again. And I think we'll see some of that rotation back into those two groups. Because I do think this secular bull market tends to carry just about everything with it to the upside. It's just a question of what leads overall for an extended period of time. And my belief is, and I know it's volatile, but I believe the growth stocks continue to outperform. I think they will throughout 2021 and into 2022. Even if rates go back up, which I think they will, we're still in a very, very, very low interest rate environment historically. And I think that should provide some great tailwinds for growth stocks as we move forward, because they're growing. There's no doubt. I mean, anyone looking at these earnings reports coming in, just about every company's beating expectations. Many companies raising guidance. And that combination is going to fuel valuations to the upside, especially when you have historically low interest rates. Moving on to the sectors here are the financials. You can see a big breakout here. After pulling back all the way back in June, you can see right here, came back up again, really went in sideways consolidation mode between 35 and 37 for about 6 weeks. That changed on Thursday and especially on Friday of last week with that big move up in the financials. We saw the yield moving higher. We're going to talk about that in just a minute, but financials doing very, very well. Materials also moving above its moving average, both moving averages, 20 and the 50. Nice day on Friday, gaining 1.45%. Not quite the 2% we saw in the financials, but still good day for materials, no doubt. Energy rose almost 1%, but we're still battling this declining 20-day EMA. We really need to get above that before we can start talking about some of the levels to the upside. There was a lot of support around 51, 52 on multiple occasions over the last few months. So if we get through 50, then we've got the 51, 52 congestion. We've got the 50-day moving average. Like I said, still a lot of work to be done in energy. Consumer discretionary, the worst performer on Friday, losing about a little more than 2/3 of 1%. The group's still fine. It's in an uptrend. It's simply rotation. Yield was moving up. Money was rotating into the financials, and money came out of some of the discretionary stocks. Speaking of discretionary, Expedia was the worst performer. Or actually, I don't know if I think it was the worst performer on the S&P 500 on Friday. Stock went up, had a nice day heading into its earnings. Market wasn't impressed, especially one of the few companies that actually missed on their earnings estimates. Travel and tourism still impacted by COVID. And of course, with the variant still raging in many parts of the world, that is certainly having an impact in that area. But Expedia down almost 8%. I did like the overall candlestick though. Heavy volume, but we closed almost where we opened. So there didn't seem to be mass distribution. It was more just mass panic at the open on Expedia. So I suspect in time we're going to see Expedia bounce back a little bit here. All right, moving on to the 10-year Treasury yield. Let me get an update so we know exactly where we are right now. 1.283. So we are down less than 1 basis point. But that was a big move on Friday. We had the jobs report come out better than expected. And really the latter half of last week, once the ADP employment report came out on Wednesday, seemed like there was a lot of selling taking place in bonds. So I think it was more, buy on rumor, sell on the news as the jobs reports came out. I'd be looking maybe for this 10-year Treasury yield to move back up close to 140. That's where we failed earlier. Maybe about 3-4 weeks ago, back in second week of July. You see, we broke down below the 140 level, which was a support level all the way over here in March. Broke below, went back up, tested it, couldn't get through the 20, and then kept going lower. And then we now have a double bottom in play. And I think if we can get through 131 or so, that would be the confirmation that this double bottom is in. In other words, I wouldn't be looking for the 10-year Treasury yield to go back down below this level if we get back through 131, 132, and especially if we can break back up above that 50-day and take out that second week July high. So those are just some of the things I'm looking for on the 10-year Treasury yield. Now, if we fail, if we don't get through that 131, 132 level, revert back down, take out these lows, then that double bottom pattern has been negated, and we can start looking for other things on the chart. But right now, and especially based on what I was seeing on the weekly chart, which I'm going to show you in just a few minutes, I'm a little more bullish on the yield going higher here. You can see, though, as soon as we got a little bit of relief here in the yield, check out the financials on a relative basis moving higher. Industrials, kind of surprisingly, didn't really bounce much last week, even though the yields came back up. Normally, these two it makes more sense to me that financials relative to the S&P 500, that they are more positively correlated to the yield. Just because I audited banks when I was in public accounting, I know what rising yields do to their bottom line. And so anytime you see the yield moving up, banks generally should profit from it. But a lot of times you'll see, when the yield's moving up, normally it's a sign that our economy is expected to accelerate, or that it's strengthening. And that normally bodes well for transportation stocks. And transportation, of course, is a big part of the industrials. So that's why we tend to see this turn back up. So far, the response in the industrials still a little bit muted, especially in transports. We'll see whether or not we get a little change in that later in the week. Anyhow, let's move on. I wanted to go over and show you something that I was looking at. So I wanted to show you the VIX. So as part of our talking technically, I guess, segment today, wanted to go over the VIX. So the S&P 500, this is a 10-year weekly chart. Actually, it goes back further than that. It says 10 years, but it goes back to 2006, I think 15-year. Anyhow, we have 15-year S&P 500. You can see we're going up. And this channel that we've been in for the last decade has actually broken to the upside. My guess is we're probably going to see that come back down at some point. If it's not September, I don't think it's going to be until next year. I'd be very surprised. It would be very unusual. Of course, there have been a lot of unusual things going on in the last 18 months, so maybe we should expect it. But it's not very often that you see the fourth quarter weak. I think from October 27th close through the January 18th close, the S&P 500 has been up, I believe, 60 of the last 71 years. So it's very rare for us to go through the months of November, December, and half of January without rising something. Net beginning of the period to the end of the period, up 60 out of 71 years. That's a pretty strong expectation that I have going into that period of the year. We're going to go higher. So the question is, do we come down in September or even into October when we start getting the next batch of earnings reports? We'll have to watch it. We'll have to see if there's other warning signs pointing to it. Last September, go back and read an article I wrote on September 3rd, right at the peak. We talked about the VIX and the fact that the VIX was rising with the S&P 500, and that's a warning sign. So if we get some warning signs and the market's extended, then yes, we want to be a little bit more cautious from a trading perspective. Now, long-term investors really don't try to time the market. So I can say, well, this, September looks like it's going to come down, but what if I'm wrong and you get out and you're a long-term investor? Then you got to try to figure out where you're getting back in. And that's what long-term investors really don't want to try to keep figuring out. They don't want to trade. They don't want to get in, get out. So from a long-term perspective, I think you just keep riding this secular bull market. I don't see anything at this point that suggests that we're going to have any kind of major correction, or certainly not any kind of a bear market at this point. So there's no need to really worry too much if you're a long-term investor. You just stick with the program, stay long. Traders, different breed. And, you want to maintain, you want to continue to participate in the move to the upside, but you don't want to be caught in a significant short-term decline with a full portfolio of stocks on the long side. So it's always a little bit of a balance. So sometimes I'll talk about being cautious. I'm talking about the near term. I'm not talking about long term. So I just wanted to point that out. But looking at this, we've gone straight up on the S&P 500. We're definitely stretched, definitely overbought, subject to just a normal 3-5% pullback at any moment. I mean, it's just hard to predict when those short-term moves to the downside will occur. And we know how quickly the market can move down. I mean, you can be down 3 to 5% in just a couple of days. Market has, something come up and just reacts negatively, some news. Maybe it's options expiring. We'll want to be careful later this month with that. But there's always, some things in the near term that can get us. But one thing I wanted to point out on this chart is notice you get this big spike in the VIX, which we got with the panic at the onset of the pandemic. So a huge move up, very similar to what we saw with the financial crisis. I mean, almost mirror images of one another, going straight up from 15, whatever, up to 80, 90. Same thing, 15, 80, 90. But what I want you to notice is as the VIX comes down and as it trends lower, that usually is the best advance in the stock market that we're going to ever see. I mean, we're talking here in 2009 when we bottomed at 666, remember? I mean, we were 1,200 in less than a year, or maybe just over a year. Yeah, it looks like it's just over a year. So, I mean, that was nearly 100% gain in a year in the entire market overall, not just one stock. The entire market almost doubled in a year. And I want you to take a look at what happened from this panic low. 2,200, I think 2,191 was that intraday low. So 2,191, and look where we are 15, 16 months later. We've got that double again. So the big moves come when the market is the most fearful. And I mean, we can look back, think about all the things we've been through since March, April of 2020. All the media, all the news stories, all the problems, the vaccine development, just everything going on, the shutdown, the reopening, what's going to lead, the Treasury yields rising rapidly, and the scare that was putting into folks. We got the inflation, we've got all kinds of things. And look what the market's done. Market doesn't care, straight up. This is what you call climbing that wall of worry. So here was the VIX at 85. And since then, it's been coming down. But lots of folks keep talking about the VIX and the fact that it's elevated. That's good. That's not bad. It's telling us that folks are not buying in. There's a lot of people that's still very skeptical. What does that mean? That means there's still money on the sidelines. I mean, the bigger gains are gone when everybody gets in. So we need to be more worried when this VIX gets all the way back down to 10. And not that means we're going to top. It just means that the majority of those big gains are probably gone. And so that's what we want to continue to watch. I mean, when you look back, and I always study history because in the stock market, history does repeat itself. It's not exactly the same, but if you learn how the market works, how it operates, you can never quite exactly predict what's going to happen, but you're not shocked when it happens. And that's kind of how I am with the market. I'm never shocked when I see something happen because it's happened before. Maybe not the same exact story, but the same reaction. It's all happened before. Now, if you look back to this huge move up, there was a big scare in 2008, 2009 with the financial crisis. And then as the VIX came down, we had a couple of what I would call aftershocks in 2010 and 2011. You can see that the selling, even though it was pretty significant, was nothing like what we saw during the meltdown. But the fear jumped significantly. I mean, when you look at history, anytime the VIX gets up into the 40s, with just a couple of exceptions, 2008, 2020, with those two exceptions, anytime the VIX gets up into the 40s, we're probably marking a major bottom. I would say these, 85, 80, 90 readings, we didn't have the VIX back in the 1987 market crash, but if we did, I remember those days too. And that it was just as much panic back then as it was for the pandemic or for the financial crisis. And I'm sure we would have seen a similar type look on the VIX back in 1987. Huge spike, and then back down we go. But throwing out these generational type lows, which is what I think the financial crisis was and the pandemic would have never happened. This wasn't an economic cycle. This was strictly a healthcare crisis that had an impact financially for a period of time. But as you've seen, we've come right back up. Look at the S&P 500 back to new all-time highs. This is where we were before the pandemic. This is where we are now. We're up 33% from where we were before the pandemic. This wasn't an economic cycle problem. This was just a healthcare crisis that we had to figure out, had to get through. And we didn't really have a whole lot of history to look back. So the reason I point out these aftershocks is I'm not going to be surprised if something happens in 2022. And I don't know what it's going to be. Maybe there's a new strain of the virus, something that takes hold next year. That's even worse than what we're seeing this year. I don't know. I'm just speculating. What I do think we could see, though, is the market, because it has come up so much, that we might get one of these aftershocks where the VIX spikes and we pull back. And I just bring this up because it'll probably seem like the end of the world in the news. But don't be shocked if it happens. And obviously, again, we're going to continue to look for any kind of signs that might suggest that something like this might be on the horizon. But that's just looking out. I don't see anything right now that would suggest that it's going to happen this week, next week, September. But it is, over the course of the next several months into 2022, first half of 2022, I wouldn't be shocked. I'm not saying it's going to happen, but I wouldn't be shocked just based on the fact that we were so fearful. People are still spooked. I just don't think it would take much for us to quickly, go through a period of a month or two where the stock market struggles. So anyway, just keep that in mind. I just wanted to bring that up, talk about it a little bit. But the overall move to the upside, I think, is unquestioned. I mean, there's no room to argue. We're in a secular bull market. There's no argument there. I would love to debate anyone who wants to say we're not in a bull market. That would be a pretty easy debate, I think. All right, let's go back to the 10-year Treasury yield, because I mentioned I thought maybe we were bottoming. And let's get another update here just to see where we are. So we're at 1.28. But these two candles right here, these weekly candles, you can see the yield had gone down quite a bit. So what that means is when the yield goes down, there's a ton of money going into treasuries. So if we did the TLT, which I will do, we should be seeing like a reverse picture. And here you can see the TLT, which was climbing, but here you can see almost the opposite of a hammer. It's like shooting stars, where you get the long tail to the upside, you come back down, close near the low for the week. So I'm seeing what looks to me to be topping signals on the treasuries and then bottoming signals on the yield. So, and I think as the economy strengthens, this makes sense to me. We're not going to be in an economy with a 10-year treasury yield at 1.2 or 1.3 forever. We're going to get back up in the 2s and 3s. It's going to happen. I don't think that's going to kill the market. It's probably going to, we're not going to see the kinds of returns going forward in the stock market that we've seen this year. So definitely don't expect that. This isn't, we're getting a lot back from what we had last year. I think the other thing that's concerning to me is just the way the economy is playing out now, where all of a sudden with all this demand coming, and now we're ramping up production to try and meet that demand, trying to get the supply up. What's going to happen when we get all this supply up and all of a sudden the demand kind of wanes a little bit? Then all of a sudden we'll be stuck with a bunch of supply. And so I think that from an economic perspective may work its way through our system next year. And again, I'm just speculating, just trying to think, the way things have evolved over the last year and a half with the pandemic, what could be lurking? And I think we could have an overabundance of supply at some point. We're going to get everybody back to work. We see the jobs numbers coming, getting better and better, more and more people getting jobs. Production's going to step up. And I think for a while, demand will be there. But you just wonder next year if the demand continues at the rate. And even if it just slows down a little bit, what's that do with the demand-supply equation? I think that's why you're going to see inflation, no problem at all. Because once we catch up, we get through this little burst of demand versus, too little supply. Once we get past this, I think we're going to maybe run into the opposite. We may see the inflation numbers go back down to zero, possibly even maybe slightly below zero. I don't know. I'm talking to myself here a little bit. We'll see what happens longer term. All right. Next up, if you do become an Earnings Beats Digest subscriber, which is free, no credit card, I just want to point out that when you'll in your mail, you will get what we call our upcoming earnings chart lists. And this is what I want to show you. So you can just click on this. And when you click on the view chart lists, you'll get this. Here are the chart lists for this week. So all you have to do is click on the, the chart list that you want. And well, first what you want to do is kind of grab this. So we're going to do copy, and then we're going to click on the link and then paste. And I now have the upcoming earnings chart list. These are the stocks that are reporting this morning. And the reason we give you this one today is, let me just go ahead and save it. Save results. We'll go ahead and do that. That was pretty quick. That's how easy, by the way, you can take this and save it right into your stock charts account. You have to be an extra or a pro member at Stock Charts. But if you are, that's how quickly you can download any of our chart lists. And we have a ton of them. There are probably 20 to 25 chart lists on our site where we do a lot of research. And if you're a Stock Charts member, boom, just download them right into your account. All you need to do is be an extra member. And I think if you're a basic member, it might be an extra $10 or something a month to get all of our work. Trust me, that $10 is well spent. And if you're not a Stock Charts member, whatever the fee is, $24 a month for the extra level is well worth it for these chart lists that we are able to give you and you can download. All right, so now I got that. So let me pull up the chart and let's go down here to, all right, there's the one that I just downloaded. So here it is. Now, the beauty of this is you can go into the view all. When the stock market opens here in about 3 minutes, I'm going to come back and I'm going to show you this, and we'll pull up the top 3 performers. But you can hit this view all and then do the summary. And what this does, what this enables you to do is track every company, all the companies that have a market cap over 1 billion for the time period shown. So for this is August 9th, before the market opens. These are all the companies that have a market cap over $1 billion that reported earnings this morning. And so when the stock market opens in a couple minutes, I can quickly look to see the reactions and which ones are doing well and which ones aren't. All right. So we're going to come back to that in just a minute. Next up, what I want to do is talk to you a little bit about earnings. So let's go over here. And BNTX reported, and we're going to look at those numbers in just a minute, but we'll do a little sneak preview here. Oops. BNTX. So the stock up $21 right now this morning, and we'll see that on our chart list in just a couple minutes. But then, you can take a look and see, I haven't looked at the numbers, all the numbers anyway. I do know BNTX blew away earnings estimates. I mean, absolutely just crushed them. Market was expecting 835. They came in at 1298. Now, not every company is like that, but I can tell you there are a lot of companies that are just beating the heck out of these estimates like a drum. And so you're wondering, okay, why is the market going up so much? PE ratios are too high. Well, PE ratios are not factoring in this kind of earnings growth. I've been saying for months, ignore PE ratios. When the economy is expanding and companies are routinely beating estimates and raising guidance, valuations are going to change because forward PEs are going to change. So when you're just looking at the PE ratio, you're taking a very static look at what the market had been expecting for the next 12 months. All those numbers are changing and they're going up. They're going to go up a lot. So all of a sudden your PE ratio is meaningless. To me, that is the PE ratio is a poster child Monday morning quarterbacking. It will work eventually because the economy is going to slow and the PE ratio at the high is going to be very high. That's why we can go back and we can look at 2000 and say, oh, the PE ratio was X. Therefore, anything at X or above means the market's overvalued. That's a bunch of crap, in my opinion. Let's look back at where the PE ratio was in 1999, in 1998, 1997, before they started upping the PE, the earnings. They were all, PE ratio was high the whole time. You'd have missed the whole 90s run if you paid attention to the PE ratios. Just like if you're paying attention to it right now, you'd be missing out. You'd have missed out on the last year. You'd missed out on the last 8 years. PE ratios, in my opinion, very overrated. Very overrated. You can always look back. You know, I can look back and tell you when all the bear markets were too. I'm brilliant, right? Monday morning quarterbacking is easy. You got to be careful with PE ratios. Another company I'll show you. Actually, we did just open, so let's look at this. See if I can get an update. Some of these companies don't open until about 30 seconds or a minute into the day. So let me see what we got here. Okay, so right now, I can tell you Shockwave Medical is getting the biggest initial reaction. And we look at the chart and look at that gap up. Now, what I do with these is I go in and I'll look, okay, 202.84 was the opening high, or that was the candle body high. Today we opened at 199.69. So we opened up, but we didn't clear that key resistance level. Now, the next 30 minutes to an hour are probably going to be extremely volatile, not just in this stock, but any company that reports earnings. So if you take a position at 9:31 in the morning, just, put your crash helmet on, strap in your seatbelt and get ready for the ride, because these stocks can move wild in the first 30 minutes to an hour. But here is, so there we opened at 199. Now we're all the way back to 196. Remember, when everybody jumps in at the open, market makers are on the short side. That's why a lot of these gap ups, you'll see selling afterwards. If you see a gap up and a lot of buying afterwards, it tells you that there's so much demand that market makers are not able to get control of the action. And so they have to start buying. If they're shorting at the open and the price keeps going up, they don't want to lose money or lose a lot of money. So they have to start buying as well. Anyhow, something to look at. Now look at it. See what happens if you get in at the open, 199.69. Now we're down $6. Pretty impressive. But you can just do this at the opening bell just a few times, just get a sense of what the heck's going on. So there's BNTX now at the top at 415. This was one I was watching. This is a software company. See what they're doing. They're up a little bit, but still sideways action. No big move there. How about some of the ones that are getting hit at the open? AXSM. Wow. Now, gap down a lot, but look, this one's a hollow candle so far, a little bit of a hollow candle. Why? Well, when everybody wants to sell, market makers are buying. And so market makers, it behooves them to drive the price higher from a gap down and to drive the price lower from a gap up. So these upcoming earnings chart lists are pretty cool to watch. And if nothing else, it organizes all the major companies that have reported into your account at Stock Charts. You can monitor them. I mean, we have some members who use these and they like to trade because of the volatility after earnings are released. Let's see what else. How about this one's only down 5%? Technology stock. I'm not really seeing anything here that, gets my attention. So let's just randomly pull three up. These will be the three you must see. And I don't even know what you must see right now. But first, Trade Desk. This is one that had that big split and then just took off to the upside. Pulling back with its earnings report, I do know Trade Desk beat 18 cents versus 13 cents. Went down, hit the 20-day EMA and bounced off of it. Look at gap down, sold off, but now we're coming back to the upside. So this one already very volatile. You can see the volatility, though, and how quickly. That's the case every day in the first 30 minutes, probably. You can see that. These big moves, but with earnings and news, it can be even, it's almost like volatility on steroids. Second one, let's take a look at Air Products. Now, they missed $2.31 versus $2.39. So they missed. And when we look at the AD line down, look at the relative strength or weakness in this case, down near 52-week low. Should you have been expecting anything great with earnings? I would not have been. I'm seeing signs of distribution for the past year, and I'm seeing a weak stock relative to its peers. we don't have access to Wall Street analysts, but to me, when I look at AD and I look at relative strength and I just look at the price chart, it's almost like I'm talking to Wall Street analysts. That's what the charts are telling me. So this is saying stay away from the stock. And now we get the earnings, they miss and they're down. Let's do a third one. And this one will be one on the upside. Tyson reported a huge number. Tyson Foods expecting $1.77. They came in at 270. 270 versus $1.77. I mean, these earnings beats are just crazy on a lot of these companies. And that's another thing too, that's going to make next year perhaps a little bit more difficult, because if you get into this mindset, oh, we got all these big growers, what are some of these companies going to do next year when all of a sudden they had all this demand in 2021 and, their supply wasn't so great and therefore they had to raise prices, which is going through the CPI and the PPI. What's going to happen next year when we start looking at the comps? So I think that could be a problem. We've seen it with some of the companies that did well during the early stages of the pandemic. Many of those stay-at-home stocks, they're posting great numbers and the market is saying, oh my gosh, things are slowing down. We don't care how great your numbers are. That's what I think the market could deal with as a whole next year. So again, and I'm bullish. Don't get me wrong. I'm bullish. But as I looked at history and I looked at the aftershock, what could it be? And I think that's part of what it could be. Anyway, Tyson's big move up off this downtrend. AD line, okay, not great. Tyson, though, relative to food products, is actually, with today's action, back near 52-week high. So this hasn't been a horrible performer. More so, it's just been a horrible group. Food products relative to the S&P have been horrible. Despite that, Tyson's still hanging in there and doing okay. Underperforming the S&P, not setting new highs, but with this move today, at least getting back some of its recent losses. All right, that's it for me. I'm going to bring up the market. Let's just see what the market's doing here as we start this new day and new week. Dow down 122 points, S&P down 10, NASDAQ down 24. So we are seeing a little bit of relative strength on the NASDAQ right now. Don't forget it is Monday blues. Those of you maybe who are new to some of the things I do. I've tracked historical data on the S&P 500 every day since 1950. And I can tell you Mondays are the worst day of the week. Some Mondays worse than others. Monday following option expiration, that's the one you really want to be careful about. If you're a short-term trader, you go into that Monday with a lot of long positions. If you go back and look at your history of your trading account, maybe you might find that you had some bad days on those days. But anyway, it is Monday. We'll see how we finish this week. The market's still, hanging in there very strongly. It's hard to really bet against this market right now. All right, that's it for me. I'll be back tomorrow for Trading Places Live over at Stock Charts TV. That'll be a recorded version. All you have to do is when you're in Stock Charts, click on the Stock Charts TV anytime between 9 and 9:30, and you'll hear me. Trading Places Live tomorrow, 9 o'clock Eastern. Have a great day, everybody. Happy trading.